Imagine waking up every morning and immediately handing over a portion of your daily earnings to an invisible partner who assumes none of your risks but claims a guaranteed cut of your future. For millions of Americans, this is not a hypothetical scenario, but the daily reality of carrying consumer debt. The average household now manages tens of thousands of dollars in liabilities, quietly draining the capital needed to build lasting prosperity. To understand this silent wealth erosion, we must examine the mechanics of compound interest. In the realm of investing, compound interest is the engine of wealth generation, earning returns on both your initial principal and the accumulated interest from previous periods. However, when applied to borrowing, this exact same mathematical principle works relentlessly against you. It transforms a simple purchase into an expanding financial obligation that grows exponentially if left unchecked. The mathematics of borrowing dictate that you are effectively shorting your own financial future. Every dollar allocated to servicing high-interest liabilities is a dollar permanently removed from your investment portfolio. Over a 30-year timeline, the opportunity cost of that redirected capital can easily amount to hundreds of thousands of lost potential returns. This is the hidden impact that prevents even high-earning professionals from achieving meaningful net worth accumulation. How did this dynamic become so normalized? Looking back at the post-war economic boom of the 1950s, the introduction of the modern credit card revolutionized consumer behavior. Before this era, acquiring debt was largely restricted to major, asset-backed purchases like a home or a business. The democratization of unsecured revolving credit fundamentally shifted the American financial landscape, transitioning society from a culture of saving for future consumption to one of immediate gratification funded by future labor. Today, that historical shift has culminated in unprecedented levels of household leverage. According to recent data from the Federal Reserve, total consumer debt has surged past $17.5 trillion. This staggering figure encompasses everything from auto loans to retail financing, creating a fragile economic ecosystem highly sensitive to interest rate fluctuations. When the cost of borrowing rises, the disposable income of the average consumer shrinks, sending ripple effects throughout the broader economy. Within this massive debt pile, credit card balances represent the most toxic threat to your wealth-building potential. These unsecured liabilities often carry an APR, or annual percentage rate, exceeding 20%. At these rates, the compounding effect accelerates aggressively, often outpacing the historical returns of the stock market. Attempting to build an investment portfolio while carrying revolving high-interest balances is mathematically equivalent to trying to fill a bucket with a massive hole in the bottom. This brings us to a pervasive myth that often confuses aspiring investors, which is the absolute distinction between good debt and bad debt. While it is true that borrowing to acquire an appreciating asset, like real estate, differs vastly from financing a depreciating consumer good, the line is rarely that simple. Even so-called good debt carries inherent risks and requires rigorous cash flow management. Over-leveraging in real estate, for instance, can quickly turn a prime asset into a crushing liability during a market downturn. Lenders use a specific metric to evaluate this risk, known as the debt-to-income ratio. This calculation divides your total monthly debt payments by your gross monthly income, providing a snapshot of your financial leverage. A high ratio not only signals distress to financial institutions, but also acts as a straitjacket on your financial agility. It restricts your ability to pivot careers, start a business, or capitalize on sudden investment opportunities when the market misprices valuable assets. But what happens when the debt was acquired not for consumer goods or real estate, but for the fundamental promise of higher earning potential? We must address an entirely different category of borrowing that has fundamentally reshaped generational wealth dynamics. How does an obligation taken on at age 18 dictate asset allocation strategies 2 decades later? The answer lies in the modern educational financing system. The student loan crisis has emerged as a profound structural headwind for long-term wealth accumulation. With millions of graduates entering the workforce carrying substantial educational liabilities, the traditional timeline for key financial milestones has been severely delayed. The capital that previous generations utilized for early career investing or initial home down payments is now routinely diverted to service student debt. This delay in entering the asset markets means missing out on the most crucial years of compounding growth, permanently altering the trajectory of their net worth. The ultimate casualty of this deferred timeline is financial freedom. True wealth is not merely a high net worth on paper. It is the autonomy to direct your own time and energy without the constant pressure of mandatory debt servicing. When a significant portion of your future labor is already mortgaged to creditors, your capacity to take calculated professional risks diminishes. The focus shifts from wealth optimization to simple survival, trapping individuals in an endless cycle of obligation. Beyond the raw mathematics, we must acknowledge the profound psychological burden of carrying significant liabilities. As Nobel laureate Daniel Kahneman observed through the lens of behavioral economics, human beings experience the pain of loss much more acutely than the joy of equivalent gains. Debt acts as a constant, underlying source of financial anxiety, subtly influencing decision-making. It often pushes investors toward overly conservative career choices or, conversely, highly speculative investments in a desperate attempt to break free quickly. This psychological pressure frequently leads to catastrophic portfolio management errors. Driven by the desire to outpace high-interest obligations, individuals might abandon sound diversification principles and chase volatile, high-risk assets. They hope for a sudden windfall to clear their ledger. However, taking on outsized investment risk while carrying significant debt is a recipe for financial ruin. If the speculative bet fails, the investor is left with decimated capital and the original compounding debt still intact. To break this cycle, we must reframe how we view debt repayment. Retiring a credit card balance with a 20% interest rate is mathematically identical to finding an investment that yields a guaranteed, tax-free 20% return. In the realm of traditional asset allocation, such a guaranteed yield is entirely non-existent. Therefore, aggressive deleveraging of high-cost consumer debt should almost always be prioritized over accumulating standard market investments, as the guaranteed savings far outweigh projected market gains. This principle becomes even more critical when we examine the historical cycles of monetary policy. For over a decade following the 2008 financial crisis, the world experienced an anomaly of near-zero interest rates, masking the true cost of leverage. Borrowing was cheap and asset prices soared. But history demonstrates that cheap money is never permanent. As central banks inevitably normalize rates to combat inflation, the cost of carrying variable rate debt skyrockets, exposing those who overextended during the era of easy credit. It is often argued that inflation erodes the real value of debt, technically making it easier to pay off with cheaper dollars over time. While this economic principle holds true for fixed-rate, long-term instruments like a 30-year mortgage, it offers no protection against revolving consumer credit. Credit card companies dynamically adjust their rates upward as inflation rises, ensuring that their profit margins are protected while the consumer's purchasing power is simultaneously squeezed from both ends. Understanding these macroeconomic forces is essential, but how do lenders evaluate your individual trustworthiness in this complex system? The answer lies in a proprietary, often misunderstood metric that dictates the cost of almost every financial product you will encounter. We must decode the mechanisms behind your credit profile and how minor missteps can trigger a cascade of increased costs across your entire financial life. Your FICO score is the universal gatekeeper of modern finance. It is a mathematical model that assesses your historical relationship with debt, heavily weighting your payment history and your credit utilization ratio. This utilization metric measures how much of your available credit you are currently using. Maxing out available limits signals financial distress to the algorithm, rapidly depressing your score and subsequently increasing the interest rates you will be offered on future loans, auto financing, and mortgages. The long-term wealth impact of a suboptimal credit profile is staggering. Over the lifespan of a typical home loan, the difference between an excellent credit score and a mediocre one can translate into tens of thousands of dollars in additional interest payments. That is capital directly siphoned away from your retirement accounts and transferred to bank balance sheets simply because the algorithm priced you as a higher statistical risk. Navigating this landscape requires a sophisticated approach to liability management. The goal is not necessarily to live entirely without credit, as strategic borrowing can facilitate business expansion or real estate acquisition. Instead, the objective is to ruthlessly eliminate toxic, high-interest consumer debt while carefully managing low-cost, fixed-rate leverage. This requires a detailed audit of your personal balance sheet, identifying precisely where your cash flow is leaking to interest payments and restructuring those liabilities for maximum efficiency. Once high-interest obligations are cleared, a remarkable financial transformation occurs. The cash flow previously dedicated to servicing debt is suddenly liberated. This is the inflection point where true wealth building accelerates. By redirecting those former debt payments directly into a diversified investment portfolio, you harness the power of dollar-cost averaging. You transition from paying compound interest to earning it, fundamentally reversing the mathematical forces that were previously holding your net worth stagnant. This transition is especially vital as we look toward the future economic landscape. We are currently on the precipice of the largest generational wealth transfer in history. However, individuals burdened by excessive liabilities will be poorly positioned to receive, manage, or grow these inherited assets. Estate planning and wealth preservation require a foundation of personal financial stability. If inherited capital is immediately consumed by pre-existing obligations, the opportunity for multi-generational prosperity is instantly extinguished. Executing a successful deleveraging strategy requires both mathematical precision and behavioral discipline. Whether you choose to target the highest interest rate accounts first to minimize total costs, or eliminate smaller balances quickly to build psychological momentum, the specific method matters less than the consistent application of capital. The key is to avoid accumulating new liabilities while methodically dismantling the old ones, creating a permanent structural shift in your monthly cash flow dynamics. Ultimately, mastering the dynamics of debt is the prerequisite for sophisticated investing. You cannot effectively evaluate the risk premiums of equities, bonds, or real estate if your baseline financial state is actively deteriorating due to 20% consumer interest rates. Clearing the ledger provides the absolute clarity needed to make objective, data-driven investment decisions. It removes the emotional desperation from your portfolio strategy, allowing you to invest for long-term growth rather than short-term survival. The journey to lasting prosperity demands a clear-eyed assessment of the liabilities holding you back. By understanding the hidden mathematical and psychological impacts of borrowing, we empower ourselves to reclaim our future capital. Debt is not merely a monthly payment, it is a claim on your future labor and a barrier to your ultimate financial freedom. By dismantling these obligations, you stop funding the profits of financial institutions and finally begin building a legacy of wealth, resilience, and true independence for yourself.